Hey guys, welcome back to Matt Money. Welcome back to another episode. Today we're going to be talking about oil again. And for those of you guys that do know or don't know, I'm a petroleum engineer by background. I currently live in Trinidad and Tobago. And so my life is oil and gas. Currently it's more so gas than it is oil, but I currently live and breathe oil and gas production at the moment. I don't really trade oil and gas with respect to having to deal with these sort of things that we're going to be talking about today, but I help produce and I help sometimes provide the forecasts that go into our own company having to then trade and figure out how they supply and provide the other refineries or gas trains with the gas that they need in order to sell these sorts of contracts. So I have a little bit of insight with it, but of course I'm not an expert in, say, futures trading. But really what I wanted to touch on is the risks associated with, or what you should know when you buy into some of these funds. Now, what we're going to take a quick look at is USCF, or US Commodity Funds, US Oil Fund that they have created. And so a lot of people like this one. A lot of people buy into it. And I'm not saying to or to not buy into this, but I think when a lot of people are automatically rushing to these sorts of funds, maybe not necessarily understanding what is exactly going on. And so I want to touch on that in this video today and kind of explain that. So what I basically want to look at is when you trade something like USO, or the US Oil Fund, you can see it kind of goes up, down, and sideways, and want to dive a little bit deeper into that because generally speaking, it's not one for one. If the price of a barrel of oil goes up 1%, you don't necessarily see USO go up 1%, which is a little bit interesting. So I kind of want to touch on why that is. So now that we are in the end of April, we're actually starting to trade June futures. And so for those of you guys that do or don't know, um, basically futures are the month ahead of time, and they actually start trading at basically a month out minus a couple days. So in this case, we just ended May's future contract. So basically everyone's going to start trying to take delivery of their May production at the end of April. And so the May books have now closed because basically in the next week or two, we're going to be starting up in May. So what that means is now we're actually starting to trade for June, meaning for all the remainder of April, and basically midway through May, we're actually going to be trying to provide oil production that will then go to refineries and stuff like that. And that's basically what they're trying to do in trade. So from now until about May 19th, which we'll get a little bit more into that a little bit later, we're going to be trading June futures. Now, what that actually means is companies like US Oil Fund and other commodities traders are trading these futures. Basically, some of them are actually buying them to help actually offset and actually find a price for their oil and gas. So they might actually have physical oil and gas, which they are saying, hey, we need to find somebody to purchase this, and they'll actually send the deliveries to whoever purchases that upon who holds that sort of future at expiration date, which in this case was Monday, Tuesday-ish of this week. And that's why you saw the negative oil prices. But we'll get into that in quite a minute here. But what you can see here is, and this number may or may not mean anything to you, which we'll kind of dive into as well, 53,500 quantities of, say, June 2020 futures. So what does that mean? So each contract or each quantity here is considered 1,000 barrels of oil. So if you wanted to kind of multiply this out, this is basically going to say 53 million barrels of oil. And what they have here is they have it at a price of about $13.78. So at the moment, June 2020, they have their futures contracts at about $13.78. So the only way that this U.S. oil fund can make money is now that they have this quantity of, say, June 2020 contracts, which is currently what's trading, the only way they can make money is basically if the future price or the current price of the spot price goes up, and it goes up, say, 5%, 10% in June. That's going to help raise this value of this particular contract. But keep in mind, the contracts for, say, July or August or July on the let's just say the London Stock Exchange, all these different, I guess, futures are trading all at once, and they're also trading them, right? So you have July and August in here as well. So if, say, June price goes up by 5%, doesn't necessarily mean that July price or August price is going to go up by 5% as well. And you can see here that they have a lot of July contracts as well. Actually, it's almost twice as much of any of the other ones in here. So specifically, if you were to look at their July contracts in total, so they have the Chicago exchange on here, which is about $1.8 billion. Then they also have the London exchange, which is about $100 million. So they almost have $2 billion worth of contracts for July specifically. So that sort of just means that, they're a financial institution. They're basically having these books and trading them. So if everything goes up, let's just say 100% in the June contract, and it doesn't necessarily move for the July contract, the actual spot price will move 100%, but U.S. oil might only move 50% or 20%. It all very dependent on how many contracts they have and what the value of the books are at the moment. Now, one of the key things that I want to kind of show here is this kind of highlighting the crude oil price and kind of giving you an idea, and we can kind of swing around and touch from time to time what exactly we want to look at. But particularly what I want to highlight here is this June 2014-ish time frame. So June-ish 2014, we're trading around $100 or so a barrel. Let's just say it's $104 a barrel. And then basically 4 years later, 4 years and 3 months later, we're trading around 71 bucks. So yes, we saw this big dive here over the course of a long time. We basically dove about 70% from the maximum oil price, and then we climbed back up within about 25% of this high back in 2014 timeframe. Then if you go to USO and do the same, you look at the same time period, about June 2014 timeframe, the fund was worth about $39 per share. You kind of go down the same pivot point. You see that 70% decline because it happened rather abruptly. And then you would anticipate that you would get back to this 70% of this $37. But in actuality, you don't get even half that point. So keep in mind, from 2014 to 2018, the crude oil price, recovered all the way up from 25% of all-time highs in 2014. But here we're seeing that we're not even recovering anywhere near close to 25% of what we saw back in 2014. If you're going from June to January to June 2018 to June 2014 respectively, you're still down 60%. So it doesn't necessarily make sense. So why is that, right? And the reason is because you're trading the futures. You're not trading the physical crude oil. You know what I mean? You're trading the financial instruments that are going into what is going to be happening. And basically what I'm trying to say is when you have these sort of financial institutions trying to buy these contracts, they can't actually store any of the oil. And so what somebody might be able to do, if say they're an oil storage company or they're an oil and gas company, they might have storage capacity in some of their facilities. And so they might say, well, we can store up to 1.5 million barrels and we can sell $15,000 or 1,500 contracts associated with that. Or maybe it's 1,500 contracts, let's say. And then what they'd be able to do is hold on to it for a week, 2 weeks, 3 weeks until the next trading month kind of comes up, and hopefully the price of oil has kind of continued to increase. So what ends up happening here is no matter what, at the end of the month, basically the fund is going to have to sell because they can't necessarily hold it and store it. So what ended up happening on Monday and Tuesday, which everyone was kind of familiar with what ended up happening, is if I kind of go back to, let's just say, the past 5 days, what ended up happening is the negative oil price, right? Everyone's very familiar with that. And a lot of this had to do with the fact that all these futures funds had all these contracts on the books, but couldn't actively and physically take storage of these crude oil. And so immediately what you would see is the contracts were ending. These funds couldn't hold on to the May contracts because obviously they can't take any money. And of course, as oil was continued to decline, they didn't want to sell it yet, but it got to the point where the end of the month happened and they had to sell it because they physically can't let it expire with it on the books, because they physically cannot receive it because they have zero storage space. And so that's the kind of reason why you might be losing potential money on some of these things, and not necessarily even realizing it. It's why over the course of time, you'll see that the price of oil, say, may increase, um, and at the same time, your USO or your USL fund doesn't necessarily increase at the same rate. Now, what I would want to say is, specifically if you're to kind of look intraday, within one day, a week, it does match pretty closely, but where it does really start to hinder things is when it really starts getting to the end of these sort of trading months. So in the case of, let's say, um, April, we were looking at the trading month kind of ending 3 days before the 25th of the month. So 1, 2, 3. Basically, they were ending on Tuesday here. So yesterday, the 21st. In the case of next, on May, we're looking at the 25th here, 3 business days before then, 1, 2, 3. So basically, we start trading July contracts, in the end, at the beginning or the end of May. So that basically means that the June contracts are basically closing on the 19th of next month, and so on and so forth. I mean, you do the same with June. So June 1, 2, 3. That means in June 19th, the books are going to be closing for the July contracts, and so once it gets to the 22nd here, we're going to be trading August. And so it's just going to continue to roll over. And these funds are here to try to make money off of the futures. Now, if you have a continued downward spiral, one, you're going to have to pay a premium for purchasing these futures contracts, and then two, you're going to be losing money. So it's almost like a double whammy. And so I think that that is part of the reason why, when you look at USO over the long term, you haven't necessarily gained a lot of money. Keep in mind, back in 2008 timeframe, this thing was trading. You had oil was at like $120, $140 a barrel. This was trading at about 117 per share. So if you think about it, now that we are $14, so we're about a tenth of that, we should have only lost, let's say, we should have only lost 90%. But here we are, and we've lost 97% since that point. And to keep another point up, 2008 we were trading about 140,000 a barrel. In 2014 we were trading at $100 a barrel, and you still lost 67%, even though oil price was only down 40% from that time period, from 2008 to 2014. So it just goes to show that not only when you buy these funds, you're paying for the premium of buying the futures, but it is what it is. How you can actually make money with these things is, let's just say now. So keep in mind that when we kind of go back and look specifically at USO, for example, they have these June contracts, July contracts, and August contracts on the books. Now, they have these purchased at, say, $13.78, $23 for August, $20 for July. And so if we were to have, say, a large change in the oil price by, say, 10-15% overnight, yes, you can for sure make a decent chunk of that. So will I say you're going to make immediately 10 to 15% because the spot price has immediately jumped? I don't know. And that's all dependent on, is it just the front month price that has jumped, or is it June, July, and August spot prices that have kind of jumped? And that's a big indicator as to whether or not you're actually going to make money. And so I know this was a really interesting explanation, and probably a little bit out there, jumping around between different things, but I really hope it finds you well, and I really hope that that gives a little bit of explanation as to, when you're investing in these US oil funds, it's not necessarily this one tracker that you're kind of seeing, and what you're actually seeing here is going to be the change, right? So immediately, if we were to say go from $14 a barrel, and in the next year, steadily over time go back up to $60 a barrel, so basically increase this by fourfold from where we are today, and it took over the course of a year, you're not going to see a 400% return, right? You're going to see a decent return for sure, but it really is all dependent on if that happens overnight. If we go from 14 to $60 a barrel overnight, you'll see a lot more money because you're not paying the futures contracts premiums of having to trade these contracts. And you're not also seeing some of the contango that you're kind of having just with having some of these contracts kind of on your books, or in this case on USO's books. But if you were to have it kind of happen between now and let's just say 2021 time frame, you're going to see a lot less. So you're going to see 100%, 200%, I don't know. But just kind of go back to remembering that even though we got to 25% of all-time highs between 2014 and 2018, even still here, we were still down 60% in USO. Basically saying that, you know, we weren't making any money. You know, yes, you would have made money if you bought back down here at this 2016 time frame and kind of came up. You would have been up 80%. But keep in mind, the oil price down here was $28 a barrel in 2016, and basically going from $28 a barrel and it 3x'd, right? I mean, it went from 28 to 54 to 76 or something like that. So that basically tripled the price, but you're only seeing an 80% return. So hopefully that helps you guys and gives you guys an explanation as to kind of what's going on when you're investing in some of these funds. What I would suggest is just limit your exposure, limit your risk. In my opinion, I will probably stay away from investing in anything like USO, USL, or any other sort of oil fund. And that's just basically me. I'd rather invest in the companies themselves. I'd rather look in companies with great balance sheets and um, great cash flow, and are setting themselves up for the future, whether that is transitioning to greener energies or whether that is just making sure that they're continuing to get their margins in line. But that's a whole nother story for a different day. If you guys are interested kind of hearing on my future outtake or future outlook on oil and gas, more than happy to provide that. But thank you. Been rambling on for a little bit. Hopefully this rant was good for you guys, and if you did like it, just give it a thumbs up, and I'll talk to you guys in the next video. Cheers.